Well, welcome back. Was a fun couple of days. Just kidding. And it's unbelievable when that volatility kicks back in. Boy, it just has a tendency to run up and down extremely quickly. Look at the 3-day chart on the Dow Jones and the S&P and the Nasdaq. It's pretty mind-boggling. And but that's kind of to be expected when you've seen a market come back as much as this one has over such a short time period. And doesn't really surprise me at all, especially anymore. But and it never really has. There's a little exercise you can do if you want to try to help yourself as an investor. Just take a little journal out, write down what you think should happen over the next day, next week, next month, and then keep track of that. When you see how poorly you're doing, you'll give that up. Maybe not. Some people, some people. Doesn't matter. So, but if you're looking at the predictability of markets over fairly short time periods, it's almost impossible. Stuff that used to work stopped working when ETFs started taking in more money than actively managed funds. Why is that? Well, ETFs are actually run by computers, and computers don't really care. They just have algorithms. They're little mathematical formulas that they use to buy and sell, and that's the way they do it. So, but I look around, I look at the long-term view is actually very positive for the stock market. It's very negative for the bond market. So we'll talk a little bit about that in today's program, and I'm going to be talking about that probably for the foreseeable future. And why do I say that? Well, bonds right now are paying so little. I mean, it's unbelievable. You get if you can find a 1.5% CD, it's generally going to be a teaser rate to get you in for 6 months, and then they're going to drop it to next to nothing. I was looking at a little account that I'd forgotten about. I opened this up. I was going to do something with it in 2015, and I put $1,500 in it. That was it. It was just try to establish an account. I was going to do a little side hustle with it. One of my kids, we're going to do something, and I just forgot about it. And I've been getting these statements all these years for the past 5 years. I go to look at the statement. It's got $1,542 in it after 5 years. $42. That's unbelievable. So anyway, that's what I'm talking about. Rates are really low. Really low. I've never imagined that you'd see a 30-year Treasury bond paying 1.47%. Not in America, but the 1 year, this is unbelievable. 0.13. A Treasury bill is you got to hang on to for a year. 0.13. That is killing me. And that's one of the reasons that you've heard me talk about the fixed indexed annuities. I just read an article in the Wall Street Journal again yesterday, and this guy left out that word fixed when he was talking about, and he was just referring to equity indexed annuities. Those are two different things. That's like comparing a kite with an airplane. They both fly, right? Not the same. Definitely not the same. Or how about this? How about one of those gliders, the big hanging glider? It's comparing that to an airplane. Now, if you want to they're both planes. You can fly with both of them. I wouldn't recommend the hang glider to go to California. I just wouldn't do that. That's going to end up bad. But if you want to go to California, you get in a big plane. You want to have fun, take your life in your own hands, and go with the hang glider. But they're both flying vehicles, and I know that sounds silly and people probably think I'm just being facetious, and I'm not, because there's an unbelievably large difference between those two. And I really like this development. This I think is a positive development. Now, there were years, I still don't like the equity indexed annuities. I'm not a big fan. I'm not. I know what the costs are. I know that the chance of making a lot of money in some of those products is very small. So, and they'd say, oh yeah, but they're safe. Well, so is a 1.4% 30-year treasury if you're going to hang on to it for 30 years. Yeah, that's safe, and you probably make about the same amount of money over that time period. So why would you do that? You may make a little bit more than that. And incidentally, the products that were introduced 5 or even 10, or especially 10 and 15 years ago are not the same ones that are being introduced today. In fact, there's a lot of them that are, it's just unbelievable. So anyway, I try to go with the things that are simpler, that are more clear. When I say more clear, it's like, okay, you got an inch of mud on your windshield, and we're going to take it all the way down where you've just got some streaks because you can't get rid of all of it. There's just no way to do that. And that's why it's important. When you're talking to somebody, you probably want to use an advisor with this. These are tough. And I'm not recommending that you run out and put all of your money in these things either. I would never recommend anybody do that with anything. The percentages are different depending on what your situation is, what you're looking to do. You have to think a little bit, and hopefully you get some pretty good guidance. And you have somebody that is a fiduciary who will ask you questions. What are you trying to accomplish? What would you like to do? And then lay out options. Here are some ways that'll get you there. And when I'm looking at fixed income, when I'm looking at bonds and bond funds, I'm looking at short-term maturities, because the short-term maturities are paying about the same as the longer-term maturities. And you're not going to make much more than 1%, if that, on a high-quality bond fund. You can find junk bond funds, high-yield bond funds, and they're not all bad. Okay, they fluctuate about as much as stocks do. And you might get a 4 to 5% income rate off that. So to have the same type of risk you're going to have in stocks, and you're only going to get maybe 4 or 5%, and you could end up having a negative 5 or 10 year return if interest rates start to go up at any point in time over the next 10 years. I don't know. I'm not really that interested in that, quite frankly. And that's why I think you've got a few choices here when it comes to fixed income. You could either say, well, I'm willing to take the super low interest rate. That's your first option. I just want the money safe, so I'm willing to accept a really low interest rate. That's fine. Absolutely fine. As long as you know. Second thing you could do is say, well, since this is part of my forever money, and that's the other thing. If this is part of money that you're saving for something for the next 5 years, you think you're going to be purchasing a new car, a new house, and you're setting this money aside, or you're going to pay for a kid or a grandchild's college education, don't put that money into long-term investments that should be held for more than 5 years, because it could go really bad for you. Just take my advice. So anyway, again, it comes back down to, what are you doing with that money? If this is a part of your retirement savings that you intend to convert into income one day to supplement your Social Security or whatever other income you have in retirement, okay, that's a different story. That's different completely. That's where the nationwide product I've been talking about for the past few weeks is, I think, a viable, very good option. It's a viable, very good option. And this product is not that old, actually. They've got tons. And there are literally thousands of these things. And now they're coming out with a variable product. That means it's got mutual funds in it. You can invest in the mutual funds, and it's got what I forget what they called it. Portfolio insurance on it. It puts a floor in as to how much you can lose, but it also there's a cost to that. There's a cap on how much you can make. Not a big fan, I can tell you that, because I can do that without using an annuity to do that. I can absolutely do that. It's called a collar. I passed the options principles exam. 1 in 1,000 people in my career ever decide to sit for that exam because it's not easy. You could do that. You could do that yourself, and you'd save yourself some money if you were doing that. Now, I'll get into how that works later, but I'm telling you, most people don't want to do it when they look at the cost of doing it. And I agree. I did all that studying, took that test, came back, started looking at the actual pricing on the products, and was like, wow, this is not even a good idea. Talk about wasting. No, I didn't waste time. The knowledge was great. It was good to be able to pick that stuff up. But it was a very long run for an extremely short slide. Okay, let me put it that way. It wasn't a waste, but it was a lot of effort for a fairly small amount of benefit. So I can tell you, normally when you're hedging a portfolio, it's pretty expensive. It's extremely expensive, actually. That's why I was not a big fan of the equity indexed annuities. The fixed indexed annuities, see, there's a key word there. It's the word fixed. It makes that completely different. It's like blue and green are both colors. Yes, they are, but they look a lot different. Well, not to me because I'm colorblind, but to most people, let's see, what would be two opposite colors? How about black and white? Yeah, that would be good. So are those colors? Black and white are different. Are they both colors? Yeah, they're both colors. By the way, there are thousands, if not millions, of shades between those two colors. That's what the annuity market is like. It is a bear. I can't believe how much stuff I have to read on that these days because somebody comes, a client calls and says, hey, can you take a look at this? And I promised all my clients, yes, I can take a look at that thing if you'd like me to. Now, normally, it'll take, anywhere from 25 to 30 minutes. Sometimes out of the norm, I'm there for several hours. And I don't really complain, and I'll tell you why. Because it has helped me over the past 32 years. In doing that, my learning has expanded tremendously from having done that. So I really, that's one of the benefits of being a client of Bullington Capital Managers. That's what it is. I'll look into these things, and I'll tell you what I find. And then I let you decide. That's basically how we work. We take a look at, I listen. What are you trying to do? What is it that you're trying to do? When I hear what you're trying to do, I'll lay out several options and say, okay, any of these should help you reach your goals, assuming those goals are reachable. I was just reading in I think it was the Wall Street Journal today. The journal's not responsible for this. The reporter that wrote this article, he's responsible. He was talking about how the long-term returns on stocks on a balanced fund were over 9% a year. Are you kidding? Yeah, they were if you go back to 1926. If you look at over the last 5 years, the average balanced fund is under 5. Think about that for a second. So the context, that's another thing. It is tough. I would hate to be an individual investor today. The amount of time, effort, and energy that you're going to put in, I'm very familiar with that. That's why I'm always tired. There was another big magazine, financial publication, and people bring out, it's showing a 40-year return on these funds who are stocks, bonds, and cash, and going, hey, bonds were paying 6%, you morons. Now I'm allowed to call them morons because they're highly educated and they're supposed to know better than to write stuff like that. Evidently, they need to go back and ask for a refund from Harvard for their MBA because they didn't learn anything when they were there. Not just Harvard, by the way. Actually, not even Harvard. I don't think I've ever read anybody from Harvard. A lot of other schools, very prominent schools. And they just, they memorized all the answers and they didn't really understand them. That's a problem. So they're looking at, and they're publishing this nationwide, and they're setting expectations that, getting a 9, 10%, 8% return, not a problem. Really? That is a problem. Unless you're going to be mostly stock, which is one of the things I was going to touch on a little earlier, so I might as well circle back around. Actually, I think I'll probably wait for that because I got about 60 seconds here or so before I have to take a commercial break. And I'm going to come back around and talk about, okay, you don't like short-term bonds because they're not paying anything. Maybe you've looked at a fixed index annuity. We'll talk a little bit more about what that is later. But what is the other option? What is the third option that you could choose, the three most obvious options that you can choose from to try to keep up returns that might be above 5% a year? By the way, the only indexes that are above 5% a year for the past 5 years are heavily laden with technology stocks. Sound familiar? Remember the late 90s? I don't know if you're that old. I am. I remember the late 90s. And actually, I got very good at momentum investing during that time period, so I really benefited from it. We may not be that lucky this time around, but there are solutions. So if you stay tuned, my name is Bill Bullington. I'll tell you what they are as soon as we come back from these commercial messages. You're listening to WHK.
So I can be healed, 'cause I'm so callous, and now I can't feel. I wanna run to
Hey, feel free to call us today, 216-901-0945, 216-901-0945. If there's something you hear here, if there's something you hear on this show that you'd like more information on, feel free to go to my website. It's bullingtoncapital.com. I'd be glad to send that to you. We got a lot of calls in on the nationwide product, and I'm going to get to back to that in just a little bit. Actually, I'm having a senior moment. I forgot what I was going to come back to talk to you about it. Oh, that happens quite often. So actually, I think it's just with all the stuff that's gone on today, it's unbelievable how upset a lot of people are. I feel bad because I'm telling you right now, the net result of this entire pandemic, the net result of this emergency is going to be change that actually causes the economy to grow. The economy will grow from this. Take a look. You look at the Wall Street Journal, and you look at a lot of the articles that are coming out there. They're having a lot of companies are having a field day, and I know a lot of companies have been hit hard. Anything related to retail, if you have to go in someplace to get something, whether it's get your tires changed, you want to go to a restaurant, you got to get your hair cut. Yeah, those businesses are hurting horribly. And my heart goes out to all of them because I know that is incredibly rough. They've had it incredibly hard during these time periods. There are some industries that have actually benefited from this. There are industries that are going to continue to benefit as the money continues to flow, as the technology develops, and these technologies become more and more commonplace. Like telepsychiatry. That's kind of interesting. And I'm sure a lot of people didn't really think about that, but it's getting on your big screen TV now. I don't know if you realize it or not, but a lot of your televisions, you can I can take my laptop and use Chromecast, and I can talk to somebody on either my computer, my laptop, or my television. And that's kind of interesting. So you're going to have a lot of doctors' voices, a lot of doctors' appointments that way. I don't think that's going back. I think you're going to have more people that are going to continue to work from home. But the equipment that they're going to need is going to be a slight upgrade to what they have right now. Do you know how many computers that is across the country? I mean, that's astronomical. To get to a more secure, fast computer that you can work, one like the one that I have in front of me here, the one I bring with me to the radio station, that was $3,600, by the way, for a laptop. Why? Because it's got a really high-end security system on it. And it's got a lot of RAM, and it's got a lot of stuff that if you're working from home, this is what you're going to want. Okay, so it's not the cheaper computer. You can use the cheaper computers, too, for a lot of stuff. But more often than not, you're working for a business, you're going to have the more high-powered computers, which means that they have to sell more software. I mean, it's amazing. I'm looking at what's happening in the climate change environment and what kind of impact does that have on the economy in the long run. And it's huge. It's huge. I just made some mental notes on that as I was driving in and was listening to NPR this morning. Anyway, I've got to take a real quick phone call. And if you want to call me, 216-901-0945. And I'm going to go right to Bob. Bob, you got a question or comment?
Yeah, Bill, I've got a question, if you don't mind waxing a little philosophical today.
Sure.
I was reading the article that you posted titled Warren Buffett's $300,000 haircut, just to let you know that some people read the things that you post.
Oh, thanks.
And as I read it, I think maybe you can clarify if I'm wrong, but the article essentially was espousing the idea of compound interest, and along with your philosophy that our young people, by the time they learn how to work with fractions and percentages, ought to be thinking about things like that. And so, and to some extent, I unless again I'm wrong, it sort of suggests the idea that holding stocks for a long time. But
yes.
My question is, I'm wondering how you think about that in contrast to in 2001, Warren Buffett came up with this a metric where he measured the market cap to GDP ratio,
mm-hmm.
and asserted that essentially when the ratio is less than 75%, he argued that the market was undervalued. When it was over 115%, he believed it was significantly overvalued. In 1929, it hit 141%. In 2000, it hit 151. And today, the ratio sits at 156. And from what I read, Warren Buffett essentially is sitting on the highest pile of cash in history because he doesn't like the price of anything. So that's how do you think about all that?
Well, actually, I'll start with the last part first. The reason that he's sitting on so much cash right now is because Berkshire Hathaway generates, I can't remember the exact number, but last time I stopped tracking it a few years ago, it was when he generated $15 billion net after tax profits. Okay. 15 billion with a B. There aren't that many companies around. I mean, he could buy an unbelievable number of small mid-cap stocks, just take them private, completely. So and he talked about that too. He's a victim of his own success. He's generating so much cash that he can't find places to put it. I would love to have that problem. That'd be awesome. But a lot of the ratios like GDP to market cap. Today's markets are significantly different than they were. So using that, I think you got to use it in the context of, okay, what else has changed in the market? The net after tax profit margins are substantially higher today, and they have been for the past 10 years, than they were in the prior 100. So it doesn't take quite as much capital to make as much money. Most of it's because you've got companies like Microsoft who doesn't even bother packaging their software in a disk anymore. You just go online and download it. They're basically selling $300 emails.
Right.
That is highly profitable. A lot more than making a car or a train. And that's a so that part has really changed. It's changed the dynamics on the market overall. And so if you look,
say that again in maybe a different way.
well, companies' profit margins are higher than they used to be.
Okay.
And if you look at the difference in market cap versus the GDP and new profit margins versus old profit margins, they're pretty similar. So the increase in profit margin has about kept up with the increase in market cap versus GDP, which it should. And because if it's not keeping up, then you got a real problem. That's a real problem.
Okay.
But if the companies are more profitable, Amazon, great profit margins. Look at Apple's profit margins. Companies like Microsoft, companies who don't actually create products but provide services to the IT industry. Profit margins on a lot of those businesses are very large because they have specialized knowledge, specialized people, they've got specialized equipment. And we've been hearing a lot of economists have been ringing the bell for years now on productivity. Well, productivity cannot get any higher. And I want to just say to these professors, have you ever heard of artificial intelligence? It's getting better.
It's probably why Buffett has, I believe, about 24% of his holdings in Apple.
Well, that was one of his portfolio managers that made that call, by the way, because he doesn't keep up with technology, actually. But he's also, I think the Mid-American Energy is the single largest solar panel farm in the country, in the world. And they do more with wind as well. So a lot of the investments that he's gotten into, because, 20 years ago, he stayed away from tech completely. So did Peter Lynch, by the way.
Right, yeah.
And so things over time, things change. And by the way, it is unbelievably difficult to try to keep up with that change and try to make adjustments along the way. That's one of the reasons I'm a huge fan of what I call rules-based investing. And Warren Buffett's got rules. He does. But his rule book is probably a lot thicker than most of the prospectuses that you get on a fund. And that's okay, because he can interpret things. He's going to go and look at certain things, financial statements, and apply some logic to it. And that's great when nobody's looking over your shoulder. But during that 10-year period where he had negative returns and was down 50%, the reason he got away with that and didn't lose his job is because he owned the joint. If he were a mutual fund manager, there's a pretty good chance that he was gone because they were firing people left and right. And so, there's always an element of luck to everybody's story. And the thing I like about Warren Buffett, too, is he points that out a lot. He points it out. He came along at a good time. The tax legislation was actually very beneficial for him when he was doing what he was doing. And he admits it. He doesn't try to take credit for things that he didn't have anything to do with, other than being the recipient of that. So I really like that about him. Peter Lynch, too. These guys are just so humble, and they could be, they're the ones that should be acting like Trump. But
they can afford to be humble.
Well, yeah, that's true. So, not a whole lot has really changed a lot. What the profitability of a publicly traded company today is way higher than the long-term averages. So they would deserve a higher valuation if you're making more money per dollar of sales. Does that make sense?
Right. Yeah.
So stocks are right where they should be right about now, which means they're probably going to go down 20% because I said that.
Well, they're likely if the Fed does anything like it's always done, they're sure to go up.
Yeah, and that is the amazing thing, because they've actually done a lot of stuff that they've never done over the past 18 months. It's unbelievable to me. I would have never believed that they would actually have the guts to do what they did.
But when you look over history of their behaviors, that
Yeah, this is new.
It's almost like they can't do anything but that. They can't do anything but put more cash into the system.
They could if they were Woodrow Wilson. They could cause the depression to deepen and become more severe.
That's right.
Yeah.
Right.
So let's not give them that idea.
Okay, thanks, Phil. I appreciate it.
Have a good weekend. Yeah, I'm a big fan of this Fed. You want to talk? You know who the most powerful man in the world is? His name is Jerome Powell, and he's the head of the Fed. Think about that for a second. This guy controls the banking system of the world's largest economy. Who could possibly be more powerful than him? You can't. It's not the military power. I'm talking about monetary power, and that's actually better than military power in a lot of ways. And Mr. Powell is the one that was talking about interest rates staying low for the foreseeable future. And I get it. We've got the issues are large. They're huge, but they're overcomable. Is that a word? How about this? We can overcome these issues, and we will overcome these issues. I don't have any doubt. And the effect of this long term on the economy is growth. It's growth because you've spawned new industries. You've pushed companies to roll out newer developments faster than they had planned. So it's going to be, the net effect of this whole thing is going to be growth. You don't have I remember what I was going to talk about. I was going to talk about the third option to what I see going forward with portfolios if you want to earn decent returns on your money. The first option, again, was just do what you're doing, run a balanced account, understand you've got 30 or 40, maybe 50% of your money in bonds. You are not going to make any money on that. The money you make on that's going to be next to nothing. If you try, you're probably going to get stung. Believe me, I've been there. If you try to increase the returns over the 1% returns you can get from a high quality corporate bond fund, you're probably going to get stung. So I'm going to leave that alone right now. And just remember, when you got 40% of your money or 35% of your money at 1%, that adds 0.35% to your total. This is where they've got to start teaching 12-year-olds like how to apply the percentages. I think they should relate it all to money. Let me tell you something. When I was 12, I had a paper out. I understood percentages. I understood getting a tip if you were able to slide somebody's paper under their door in the apartment that they lived in so it didn't get stolen or stepped on. Anyway, percentages are key. You've got a third or more of your money. You've got 20% of your money. You're going to do 20% lower than somebody who's got a diversified stock portfolio. That's the bottom line. Wow, I can't believe I got to take another commercial break. That went fast. Hey, you're listening to Bill Bullington. I'm right here on 1420. Stay tuned because I will be right back.
Just in time, I caught you trying to survive. Well, I may not be the greatest man to walk this earth, but I know who is.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. I think you can find this on this show on the Fishes podcast. You can also go to my website, bullingtoncapital.com. If you have a question, you'd like to reach out, you'd like me to call back and answer that, no problem. If you'd like to come into the office, we are open. Most of my building is not, but we're there. And we've got plenty of space, and we have hand sanitizer and masks for anybody that wants to come in. If you want a free, no obligation, get acquainted meeting, not a problem. You hear something you like, you just want to hang out and talk. And I am in the process, by the way, of trying to find a space for an investment club. You guys know who you are. And this week I'm going to go out and see a space. So that should be pretty interesting. I would actually pay someone else to do what I do for a living, actually. A large part of it is really fun, and it's can be very rewarding. Is it difficult? Oh, yeah. Part of what I like about the challenge, because it is challenging. I like the challenging part of the challenge. So I think Donald Trump may try to steal that line. Just kidding. But anyway, I'm just looking at it. One of the scans from the Bullington, from the Lookout for the Bull. Wow. I mean, I'm looking at yesterday. You would think that we were in the middle of a bull market, not a 3-day decline that was over 5%. It's unbelievable how many stocks in the last half of Friday came zipping back. It was unbelievable. One of the scans that I'm looking at, it's got 62 names on it. I mean, 60. That's typically what happens in a big bull market, not a market that's just gotten slammed 3 days in a row. So I guess that's one of the reasons that I feel a little bit perkier today. I was watching those scans and going, wow, this is that's pretty interesting. It's pretty amazing. So the valuations on stocks, not bad. Not bad given the price to sales ratios, by the way. That's a much better tool. And the very first time I'm able to do another seminar, we've been trying, eventually we will. I'm going to show that price to sales ratio rule. Maybe I'll have Mike Seeger. He's the guy that runs the Lookout for the Bull website. He talks about it a lot on his daily posts. But that's a pretty good benchmark if you know how to use it for determining how overvalued or undervalued a stock might potentially be. And maybe in future shows we'll actually, I will. I'll tell you what, future shows, the last 15 minutes of the day, I'll start to go through some of that stuff. I'm going to write some of the columns on it. It is relatively simple. I mean, it's very simple. In fact, I'll give you an example. Apple comes up. Let's see where Apple is. Oh, it didn't come up on a 1-month scan. It came up on the 3-month scan. Huh. That's pretty cool. So we have different time periods that we look at. So I have to go to a different spot. It figures that would happen. I think Apple's price to sales ratio is not super cheap. Is it a great company? It sure is. I mean, talk about profits. Holy cow. Those guys deliver an enormous amount of profits, or have delivered for quite a while now. And you can't always guarantee that. I remember when everybody thought Apple was going away, they literally thought Apple was going to go bankrupt. Apple sold for less than the amount of cash they had in their checking account after you subtracted all their debt. Okay? So you were able to buy Apple on a per share basis for less than the amount of cash they had in their checking account. That was a long time ago, but it's actually happened more than once. So anyway, I'm going to try to pull this up really quickly. Yep, here we go. So Apple's revenue trailing 12 months was $273 billion. That's billion with a B. The market value of the stock is a little over $2 trillion. Its price to sales ratio is 7.8. That means 2 billion is 7.8 times 273 billion. I'm sorry, 2 trillion is 7.8 times 273 billion. Now, I'll actually go through that in more detail next week because I will not have time to finish that if I start that conversation. Somebody's calling. I got to take the phone call right now. Anyway, hey, Brian, is this the Brian I think it is?
Yeah. Hey, Bill.
Hey, how you doing?
Good, thanks. Had a quick question on the scans.
Yep.
Or on the, the report that we get in the email.
Sure.
On the Lookout for the Bull site.
Uh-huh.
Sometimes, like a couple days ago, I've noticed this a little bit. Sometimes the stocks are not up on that day. Is that
That's
possible?
because yes, it is.
Okay.
Well, and that's a flaw in the software. They just upgraded that software.
Okay.
And I know how to make the adjustments to that. And Mike brought that up to me too, the guy that's running it.
Oh, Okay.
I'm going to have to make adjustments to it because they rolled out a new version of it and it has to be fixed. So
I got you. I just didn't know if you were aware or if I
Yeah.
was missing something. I thought, well, shoot, maybe if the stock opens 10% down and then it closes 2% down, maybe that would be still worthy of, so I thought maybe I was missing something.
it actually would, because if you had a day, we measure where it closes in relation to the
That's
high
still
and the low.
momentum.
Yes, absolutely. And by the way, I've seen a ton of companies do that where they would gap down, the stock would go way down, and then would reverse and erase most of that day's losses, and that was actually the start of a new trend. I've seen that happen. I can't tell you how many times. So
Interesting. Okay.
yeah, yep.
Well, good deal. I just wanted to make sure I wasn't missing something or whatever, so it was more like a glitch. Okay, cool.
Yeah. And by the way, the fact
Thanks
that
so
they're the fact that they're in the top 10% of all stocks for performance over a short time period, that part they don't get wrong typically. I haven't seen them get that wrong for a really long time. So,
Oh, okay. Awesome. Thanks, Bill. Appreciate it.
all right, have a good day. And if you want to call in, actually, I would probably say just call me in the office, 330-664-0700, or go to my website, bullingtoncapital.com. I'll be glad to reach back out to you to talk about all these things. Most of the stuff that we do, by the way, is pretty conservative. The vast majority of stuff is conservative. The stock portfolios I use for the vast majority of people, I call it my Department of Labor model because it was developed back when they first brought those rules out about 6 years ago. It was to comply with the rules that the government had put out for fiduciaries. And I like it. And I've got the vast majority of my stock money in there, but I have healthcare and semiconductor models that are in there as well. More aggressive, more concentrated. The stocks that are in those portfolios are also in the more broadly diversified portfolios, but they're just more concentrated into those. So if you'd like to see a report on that, what that model looks like, that healthcare semiconductor, and that's actually what we call them in our code in the office when we elect to invest somebody's money that way. We call it the HSDOL model, healthcare semiconductors and the Department of Labor. Isn't that crazy? You have to create acronyms because the government says you better be investing your money this way, or we're going to come and take your practice away. That's unbelievable. But I get it though. They're trying to do the best thing for the general public. That's fine. We can deal with it. To get outside of those rules, you just have to write it down. You just have to write it down and keep it in your file. That way, auditors come in and everything's fine. By the way, I didn't get to the whole topics. The three things I wanted to talk about was, the first one was you can buy the 1% bonds, keep 30 or 40% of your money in there. No, that's going to be a drag on the portfolio. The second option should be kind of obvious. You just increase the amount of stock you have, but you better buckle up when you do that, because stocks, you saw how volatile they are. They can be in just a few days. That's 4 or 5% in 2 days. Yeah, actually 4 or 5% in a day is not uncommon anymore. But so when you're increasing the stock percentage of your portfolio, you can't do that without increasing the risk. Okay, so you have to understand that, and you got to be good with that. Okay. The third option is one I've been using lately, is because they've come out with this new product. It's a fixed indexed annuity. The word fixed has got to come first. If the word equity comes first, I'm not a big fan. Not a big fan of that. The variable, those are mutual funds that are inside of annuity. Some of those are okay. You got to look really closely, find out what the expense ratios are, because some of them charge 4% a year. That's hard. That's really hard to make money with. So you just have to be careful. And if you want to talk about it, feel free to give us a call. Drop me an email, no problem. That's actually what I do most of the day now. I return emails. I have conference calls on the phone, and then I have 1 or 2 meetings in the office during the day. I can't believe how much stuff I'm doing over the phone, though. That is mind-boggling. It's kind of cool. I mean, I'm doing a lot of stuff that I wouldn't have thought that I would be doing, but, given all the situation, that's why I was saying, if I'm doing this, and I bought a super high security, super laptop, to do that with, and that's great, because I know And I was just thinking to myself, if I'm doing this, how many of these big firms are doing this? And I know that the vendors that we deal with, Fidelity, E-Trade, they all have people working from home right now. They all do. And things have slowed down a little bit, but not nearly as much as I thought they would. I thought that they would really drag. It's been slower, and it's been a little, significantly slower, but not nearly as slow as I had anticipated. I really thought it was going to be a lot worse than that. So I'm pleasantly pleased by that. Now, I was working on some material that I'll probably run on next week's show. It's the results of what we can do about climate change. There are some things that are probably going to make some big companies a whole lot of money and probably save our atmosphere in the process. So you want to tune in next week to hear that. In the meantime, I'm Bill Bullington here every Saturday morning from 11 to noon. Have a good week, everybody. Good luck. Good investing.